Headline CPI came in at 2.7% year-on-year, and it's in line with estimates. That's good. No major surprise. And then core CPI without food and energy, it's at 2.6% year-on-year. While it's still far and nowhere near the 2% target, but evidence show that price increases are moving back to 2% target. And then traders are betting that the next rate cut will only happen in mid-year. Zooming into the key items of inflation, shelter, still a sticky problem, is at 3.2%. Food inflation picked up a little at 3.1% because tariffs are bound to nudge it a little bit higher. Some tariff-sensitive categories, like apparels, also gained. But some areas like goods, like used cars and trucks, show some signs of deflation. Some comments from Morgan Stanley is, still only modest pass-through from tariffs. And now, most people aren't that worried about inflation. Policymakers feel that Trump's tariffs' impact is only temporary. Everyone is more zoomed into the labor market, which is pretty much the mover of the U.S. stock market right now. And the underlying factor is interest rates. Let's look at JP Morgan's concise comments on U.S. resilience. Odds of U.S. staying in expansion mode in this year is 80% high, and there's 20% chance that the economy exceeds expectations and go into re-acceleration of inflation. But the odds are low, 2025 as a whole, because of tariffs, especially April, the tightening of immigration, which affects labor, and then a lot of flip-flops in policy. All of these brought a lot of volatility last year. But however, economy still kept moving. The latest data, which is 2025 quarter 3 versus 2024, GDP growth came in at 4.3%, far exceeding expectations. So, JP Morgan's view is resilience will very likely extend into this year. Key macro constraint is loosening, starting with inflation, and the forecast for inflation is about range-bound at high 2%, but eventually tapering down. Then, there's a breakthrough in AI innovation, which will bring opportunities. Many big financial institutions are banking on AI growth. There are 3 reasons that growth will stay supported in this year. Labor market is expected to improve while it's still weak, but the likelihood of it further deteriorating is low as it's currently at historic high. And then, talk of job cuts currently is limited. There are early signs of small businesses hiring, and everyone is anticipating interest rate cuts, so lower rates will stabilize the labor market conditions, simply because businesses will face lower cost of capital and give them some confidence to expand. The labor market doesn't need to be red hot, it just needs to stop dropping. This chart on the right, you see small business plan to increase employment. So then CapEx, right? At around October and November, a sell down in the US stock market happened because concerns were centered around high CapEx in AI sector. So capital expenditure basically is long-term expenses needed to sustain and grow a business. Easier financial conditions, so again, lower interest rates, will help extend the runway. In CapEx, it's not just in AI, but it's in every business. Transportation industry, industrial machineries, non-residential structures. All these need high CapEx, especially when they're very hardware-intensive kind of businesses. So yes, AI CapEx is the headline because they need a lot to grow, especially related to semiconductor and data centers. But they're not the whole story. Other industries also need CapEx. The last one is the One Big Beautiful Bill Act. That's basically Trump's potent way to support growth. It's a fiscal support. This tax refund basically helps improve consumer spending and then spur business investments. JP Morgan estimated that consumers will receive an extra $50 to $100 billion from this tax refund. That's 0.2 to 0.4% of annual disposable income. After Venezuela, there's Greenland. 8 NATO members. Trump is targeting them with tariffs now. He'll only stop until the deal for purchase of Greenland is finalized. The 8 members are Denmark, Norway, Sweden, France, Germany, UK, Netherlands, and Finland. Soon, in 1st February, the tariffs will be an additional of 10%. And in mid-year, 1st June, it'll go up to 25%. Trump will do the same for countries that don't go along with Greenland, the purchase of Greenland. Presumably, the 10 and 25% will stack on top of existing estimated average of 15% that European countries are already facing from US. So that will be 20+% to 30+. This is Trump's response when Greenland's European allies sent troops to over for support right after Trump utilized US military in the attempt to acquire Greenland. The ambassadors of EU had a meeting recently, and the Supreme Court will very soon rule on whether to strike down these tariffs from Trump. And then there's some comments which pretty much summarize the whole thing. By threatening tariffs on NATO could increase costs for U.S. families, and then adversaries like Russia and China benefit from it, because the relationship with EU and Trump will then be more scattered. Here's a background on Greenland and why Trump wants it so badly. Firstly, Greenland is the world's largest island. On the right, the map is like that. Greenland is in between Russia and the US, and it has very critical shipping routes, which is placed very strategically between Europe area, Canada, and US. Greenland is controlled by Denmark and part of NATO. They have the right to declare independence if they want to, and is of strategic importance to US military and early warning of radar system. Basically, any missiles that go towards North America from Europe or Russia, Greenland will see it, because the missile will go past Greenland. Greenland holds vast natural resources like lithium and graphite. These are very important for defense and tech industries, and Trump wants this because then they can be less dependent on China for such materials. And the beauty is, these resources, a lot of it are still underground because extraction projects have been stopped, because Greenlandic people would prefer their hunting and fishing grounds to be untouched. So that's why all these extraction projects stopped. So, for Trump to claim it, US get to enjoy these raw materials firsthand. To zoom in further, there are some details about misconduct from Danish authorities on Greenlandic people. For example, forced contraception on young Greenlandic women and forced removal of Greenlandic kids from their parents to Denmark. People of Greenland want independence, but they also know that if being independent, the economy is too fragile. The 56,000 people there are too dependent on Denmark and too dependent on fisheries industry. So that's the short background on Greenland. Now on to UK, the second largest GDP economy in Euro area. November, month of month, the economy expanded 0.3%. That's more than expected. There was a drop in October because of a cyber attack at Jaguar Land Rover. That affected car productions. In the group, Jaguar Land Rover is still performing well. But Jaguar for years, they've been losing money. And worst, they recently got rid of the iconic Jaguar logo and replaced it with a new minimalist J logo. A lot of people are losing confidence in that area. And services and production are both okay. Constructions fell a little. More importantly, there are tentative signs of labor market stabilizing, and economists expect UK economy will improve this year simply because the Bank of England has been cutting interest rate and will very likely continue to cut. So that's good for the entire Euro area. A lot of unit trust and mutual funds, they tend to have UK as the top 4 holdings. So, China, the 2025 wrap-up. December exports growth catapulted trade surplus to a record high. Export full year 2025 grew 5.5% and imports stayed flat. This also highlighted the weak domestic demand. But on to the good first. Exports brought trade surplus to $1.19 trillion, up 20% versus 2024. This is their biggest driver, the strongest engine for growth in 2025. For trade with the US, exports dropped a lot, 20%. And China also bought lesser from US imports declined almost 15%. China ramped up shipments to non-US market. This trade imbalance currently brings concerns to major trading partners. They're worried because China floods their markets with cheaper Chinese products. That's hurting their local producers, the local businesses. Very likely, and soon, the trading partners might protect their own economies. So because of the strong growth, policy will very likely stay the same in Q1 this year. And some highlight is October last year, 2025, there's a trade truce with the US for 1 year. Lastly, the World Bank increased the forecast of China growth in 2026 by 0.4%, landing at 4.4% GDP growth this year. Because more stimulus are expected to come in, particularly the officials talked about improving their big problem, the weak domestic demand. On to 2025 GDP. Q4 came in at the weakest pace in nearly 3 years because of weak domestic demand. But for the full year, 2025, they hit their 5% target. Despite trade frictions with the US and the continuous weakening of real estate industry. This is very good news. So contributors of GDP, net exports brought in about 1/3, 30+%. Consumption contributed 52%. So as a whole, 2025, China came in strong because of the trade truce and diversifying from US for exports, with a very high trade surplus at 1.19 trillion. Retail sales came in quite soft, softest since December 2022. This is another sign that highlights the weak domestic demand. Industrial output, a large GDP contributor, climbed 5+%. And then fixed assets investment. Look at the chart at the right. From 2023 to 2025, January or quarter one, whole 2 years. Typically, fixed assets investment tend to be strong. Then, at about April 2025, it starts declining constantly. Fixed assets include infrastructure and transportation-related kind of things. But more importantly, it includes real estate. Then, investments in property development continue to drop. 2025 as a whole, it dropped 17+%. Way worse than 2024, which was close to 11%. This is still the issue, which is possibly the biggest reason why domestic demand is weak. Next, unemployment didn't change, at 5.1%. Chinese economy since 2024 onwards have been very reliant on exports for growth. But soon, exports will face more headwinds? Well, from Trump. And even if China diversifies exports to non-US countries, soon those countries might also put some barriers on Chinese products, even though they know that residents will benefit from the cheaper Chinese goods. But then, the latest development is Trump threatened a 25% tariff on countries doing business with Iran, which includes China. To end off, everyone is hoping for meaningful stimulus from China to boost their biggest problems, the real estate problems and domestic consumption.